Good evening, everyone, and thank you for tuning in to the first Verizon Retirement Master Class of 2024. I'm Bernard Carter from Hapanowicz Associates Wealth Management. Interest rates have been on the move over the past couple of years. This evening, we're going to be talking about the interest rate environment and what effect, if any, it should have on the timing of your retirement decision. Just a couple of housekeeping items before we get started. As I mentioned earlier, I am with Hapanowicz Associates Wealth Management. We are not affiliated in any way with Verizon, Verizon Wireless, or any other subsidiary of Verizon. Also, we are not affiliated with the CWA, the IBEW, or any other union that represents Verizon employees. We are an independent wealth management firm, and we have been helping Verizon employees with retirement planning for over 27 years. Also, please be sure to check out Retirement Red Zone. This can be reached via our website at hapanowicz-associates.com. Once there, please click on Verizon Retirement. The Red Zone is an online resource dedicated to providing Verizon employees with relevant and timely retirement planning information and tools. So let's talk about what we'll be covering today. First, we'll take a high-level view of interest rates and go over the role that interest rates play in our economy today. Next, we'll examine why interest rates change over time. Why don't they remain at a constant level? Why do they go up and down? And next, we'll ask the question, are we at an interest rate inflection point? Interest rates have been on the move over the last couple of years. They have risen dramatically, and many have observed that 2024 may be the year when they start coming down again. We're going to take a look at that and talk about that. And of course, we're going to take a look at interest rates, the effect that they may have on your lump sum, your annuity, and your potential retirement income. And then at the end, we're going to bring it all together with some numbers, some analysis, and a couple of case studies. By the way, I didn't mention earlier, please feel free to ask questions in the chat feature in the webinar, and we'll do our best to get to them all and answer them at the end of the presentation. Okay, let's begin with some basics on interest rates. What are they and what role do they play in our economy? Well, not surprisingly, money is not free. It has a price, and that price is called interest or the interest rate. Interest rates are simply the price or cost of borrowing money. Savers who have put off consuming today are the ones who charge this price. Borrowers who want to consume more today than they may have in the bank simply pay the price. Now, interest rates are also a reflection of where we are in our economy today, whether we're expanding or contracting, and they have a role in influencing the future direction of our economy. Lower rates reduce the cost of borrowing and therefore promote growth. However, rates that are too low for too long can create inflation, and this can be a problem. One thing that you can be sure about with interest rates is that they are always changing. Why is this? Well, the main reason is that money is subject to supply and demand. When individuals and businesses are looking to borrow, this usually leads to higher rates because of the higher demand for money. Now, our central bank, which is called the Federal Reserve, also plays a big role in setting short-term interest rates in our economy. The Fed will raise or lower interest rates depending on whether it thinks the economy is running too hot or too cold. Longer-term rates, like the 10-year Treasury or the 30-year Treasury, usually move in response to the moves by the Fed, but the dynamics of the intermediate and long-term bond market also play a significant role in the setting of long-term rates, and they will occasionally diverge from the movements in short-term rates that are being enacted by the Fed. So many people are asking today, where are we exactly with interest rates? Are we about to see a big move? So let's take a moment and just go back in history to the financial crisis of 2008. If you remember back to that time, we had a significant downturn in the stock market. We had a significant downturn in the real estate market, and the economy slowed dramatically. Now, at that time, the Fed quickly lowered interest rates to give the economy a shot in the arm, and it kept rates low for many years. So now if we fast forward to the COVID crisis of 2020, at that time, the government injected massive amounts of stimulus into the economy to stoke it, to revive it. And this created a fair amount of inflation that we've been dealing with for the past couple of years. Well, in response to this, during 2022 and 23, the Fed put through a series of interest rate hikes to try and control the inflation. Now, many have looked at this and commented that rates were too low for too long, and we are just now getting back to a period of more normal interest rates. And experts, however, many of them are predicting that rates will move lower in 2024 now that inflation is moving lower as the Fed makes moves to keep the economy strong. So, we've got a few cross currents at play here, and there is some uncertainty. And the question for you is, amid all this uncertainty, as you evaluate your retirement decision, how should you be thinking about these potential changes in interest rates? Step one in answering that question is probably for you to understand what effect these potential moves in interest rates will have on your retirement benefits, including your pension annuity or lump sum. So when you retire from Verizon, if you choose the annuity pension option, you're going to receive a series of equal monthly payments for the rest of your life. Now, the amount of this annuity is calculated based on three factors. Number one is your pension band, which is set by the contract. Number two is your years of service. And number three is your age. And number three only kicks in if you retire before the age of 55 with less than 30 years of service. Now, you'll notice that interest rates are not on this list. The calculation of your pension annuity is not affected at all by changes in interest rates. Conversely, your pension lump sum, that calculation starts with the amount of your annuity. And then it applies a calculation called discounting. Now, discounting requires the use of an interest rate. So as a result of this, the calculation of your Verizon pension lump sum is heavily influenced by changes in interest rates. Okay, so we know that interest rates affect the value of your lump sum. Most, if not all of you on the call today have known this for some time, but let's take a deeper dive into exactly how that works. So again, your lump sum benefit calculation will use a reference interest rate to discount the calculated annuity payments back to what we call a present value. And that present value is equal to your lump sum. Now, depending on your job title, Verizon chooses among several different interest rates, such as the GAT rate or the 10-year U.S. Treasury, to calculate your lump sum. Now, these rates tend to move in the same direction. So rather than focus on which rate will be used in the calculation, it's probably more helpful for you to understand and pay attention to where rates are going directionally around the time of your retirement. Of course, you can always request a pension lump sum calculation from the benefits center, either online or over the phone. Okay, so in the discounting calculation for your pension lump sum, there is an inverse relationship between interest rates and the lump sum amount. Thus, lower interest rates will lead to higher lump sum calculations. And of course, the reverse is also true. Higher interest rates will lead to lower lump sums. This table has some numerical examples of the inverse relationship between rates and lump sum pension calculations. In this example, we have a Verizon employee who's retiring at age 55 with a $1,500 per month pension annuity calculation. Now, if this employee were to retire in an interest rate environment where rates were 2%, the approximate value of that employee's pension lump sum would be just under $400,000. Now, let's take that same employee, same age, same pension annuity calculation, and let's have them retire in a 6% prevailing interest rate environment. And you can see the dramatic difference in the lump sum. The projected lump sum at that interest rate would be $247,000. That's a big difference from the $400,000 in the 2% interest rate environment. Okay, this is really my favorite part of the presentation, and this is where I think things get interesting. We have looked at how changing interest rates might affect the value of your lump sum. But let's now look at the other side of that coin. Let's examine the effect that changing interest rates might have on your retirement income stream. A couple of slides ago, we examined how higher rates will lead to lower pension lump sums. So should we then say that it's always better to retire when interest rates are lower? Well, maybe, maybe not. Let's take a closer look. The factor that causes pension lump sums to be lower when rates are higher, we'll call that the discount factor. Now, the discount factor does lead to lower lump sums when rates are higher. However, keep in mind that this lower lump sum, when you receive that money from Verizon and you look to invest it, you will invest it at these higher interest rates. And we're going to call that the investment factor. And in many cases, the investment factor may result in higher income and a higher income stream for you from an even smaller pension lump sum. And this is very, very important to keep in mind if you are planning on investing your lump sum to produce income during your retirement. So let's try and further illustrate this concept with a couple of case studies. So in case study number 1, we have a hypothetical Verizon employee, John Smith, who's retiring at age 55, and John has a $1,500 per month calculated pension annuity. And John is retiring in an interest rate environment of 2%. That's his reference interest rate. So on those numbers, John's calculated pension is going to be, the lump sum is going to be, again, just under $400,000. So when John receives that check from Verizon for $399,907 and he invests it, he's going to do that in the rate environment that produced the reference interest rate of 2%. So assuming John invests that money at 2%, he will earn about just under $8,000 per year in retirement income. Now let's look at case study number 2, which is another hypothetical Verizon employee, Jane Doe. And Jane retires at age 55, same as John, with a projected $1,500 pension annuity, same as John. But the difference is Jane retires with a reference interest rate of 6%. So we remember the relationship, inverse relationship, higher rate, lower pension lump sum. We see that Jane's, in this scenario, Jane's expected pension lump sum is $248,000. Now that is a lot lower than John's pension lump sum. In fact, it's 38% lower. But remember, let's come back to now the investment factor. Rates are high. The reference rate is 6%. So let's assume that Jane can invest her lump sum at that 6%. Jane's going to take this much smaller lump sum and invest it at 6%. She will earn $14,866 per year in retirement income. That is 86% higher than the projected income that John would earn, even though her pension lump sum was 38% smaller in value. So listed on this slide, there were 3 takeaways that we'd really, want you to grab onto and walk away from this presentation. First of all, of course, this presentation was focused on really one narrow area of retirement planning, and that is interest rates and how they can affect your retirement benefits. Of course, comprehensive retirement planning covers many other areas. You need to take into account, for instance, your household budget, how much debt you have in your household and what the plan is for repaying that debt. You have to take into account when you retire, of course, that you're going to forego your salary and benefits. Can your budget handle that at this time? Very important consideration is the timing and amount of your Social Security benefit. How much do you have in your 401k? And do you have any other assets that could potentially produce income for you during your retirement? That's a very important input into the retirement planning process. And finally, the last one we have listed in this slide is what is your investment risk tolerance? Are you an investor who can tolerate having some stocks, a modest amount of stocks in your portfolio? Are you an investor who can tolerate having an even larger percentage of stocks in your portfolio? The more stocks you have in your portfolio, the more of an allocation you have to this asset class. In general, the higher you can expect your long-term rate of return to be. And that cash flow planning is a very important part of the overall financial retirement planning process. Now, all of this said, if you are planning on selecting the lump sum option from Verizon when you retire, you absolutely should start to pay close attention to how interest rates are moving directly in the months leading up to your retirement. You absolutely want to know where rates are today and where they're headed so that you can begin to understand where your lump sum value projection is headed. However, as you do this, you do not want to automatically assume that it would be best for you to retire when rates are at their lowest point to allow you to maximize the value of your lump sum. You should always keep in mind that if your plan is to invest at lump sum in retirement for income, the investment factor could potentially result in an equal amount or even a higher amount of income in retirement for you than you would have otherwise seen if you had retired when interest rates were lower. So I'm going to take a look now at the chat box and see if we have any questions. One question is it ever a better idea to receive an annuity versus a lump sum? That is a very, very good question. And in general, we always tell Verizon pre-retirees that it's largely a function of personal preference. One of the benefits of choosing the annuity is that all the work is done for you. Verizon will make the calculation and they'll neatly slice and dice that your pension value up in monthly increments and send it to you for the rest of your life. There's no responsibility for you to manage a lump sum on your own or engage an advisor to manage it for you. So the annuity can be better for those who don't want the responsibility of managing a sum of money on their own and creating an income stream. I'd say that's the primary advantage of the annuity over the lump sum. The lump sum carries more responsibility into retirement. With that responsibility comes flexibility, of course. You can change the amount of income month to month or year to year if you're managing your lump sum. You can really fine-tune your investment allocation to dovetail with your preferences and your goals. And then you may have, if with good planning and good cash flow management, you have control over this lump sum that you can potentially leave to your kids or to your heirs. So those can be the benefits of the lump sum. But to your question, the annuity generally is better for those who do not want the responsibility of managing a lump sum of money in retirement. So there's a question about the GAT rate and all the other rates that are used as reference rates to calculate the pension lump sum. What I'll say to that is, the GAT rate is generally, GAT stands for General Agreement on Tariffs and Trades, and it's an interest rate that is used in the marketplace. One of the big ways that it's used is to calculate pension lump sums, and it's generally tied to the 30-year U.S. Treasury. The PBGC rate, Pension Benefit Guaranty Corporation rate, is another commonly used rate in the marketplace. It's used by Verizon as well to calculate pension lump sums. Also, the 10-year Treasury rate is commonly used. So the one thing about these calculations with Verizon, you as the employees, you really don't have the ability to choose the rate that's going to be used. Verizon will choose that rate for you. So again, as I had mentioned during the presentation, I think it's probably best to focus on where rates are going directionally. And once you get within 2 years, 18 months of retirement, you start paying attention to where rates are going directly. Maybe get get a pension estimate, and then pay attention to whether rates are going up or down, as your retirement day approaches. We send around a notice quarterly to all of the folks on our mailing list or email list, letting you know about the updates to the Verizon reference rates. And if any of you, I'm going to scroll to the next slide here in a minute, and you'll be able to get get an email address and a phone number. If any of you are not on that list and you'd like to be on that list, please be sure to email or call, and we'll get you on the list to get updated updates that we provide to the Verizon reference rates. So another question, can I explain the investment factor again, please? So when Verizon uses a reference rate to determine the value of your lump sum, and so let's say, in one environment that rate can be high, in another environment that rate can be low. Of course, we know 2 years ago rates were low and pension lump sums were coming out very full. They were larger than we're seeing today because rates were so low. And that's the discounting factor. When rates are low, the discounting factor means that the computation leads to high pension lump sums. However, remember, when you got that lump sum, you were investing that money in a prevailing interest rate environment. You were maybe able to get 1 or 2% on the fixed income side of your investments, not the stock side, not the equity side, not the growth side, just the fixed income side. You were facing yields of maybe 1 to 2%. Conversely, now that rates are higher, lump sums have moved lower. So you're looking at getting a smaller amount of money in your lump sum. However, you can turn around and invest that money at maybe 4 or 5% today in today's rate environment versus the 1 or 2% that you were seeing a couple of years ago. That's what I mean by investment factor. What interest rate environment are you facing? When Verizon hands you your money, interest rate are you able to receive when you go and invest that money? That's the investment factor. And that's the equalizer that I think can make the difference or even, be better for retirees in a higher rate environment than when rates were lower and lump sums were higher. We always like to tell folks that higher or lower rates are nothing you shouldn't fear them when you're thinking about your retirement planning. It's just something to be planned for. We have to understand it, get our arms around it, run the numbers, know where we stand, and then we can make a plan. We can integrate that into your financial plan, your retirement plan, and we can make good, quality, informed decisions about next steps. And the investment factor is as much a part of that as the discount factor. One last question. So, question about the fixed income side of investing. What we mean by that is, if you have a balanced portfolio that you're investing in either before retirement or in retirement, a balanced portfolio will generally consist of some equities, some stocks, and some bonds. The bond side is what we mean by fixed income. And that's where yields matter, like where yields are in today's marketplace. A couple of years ago, bonds were yielding 1 and 2%. Today, they're yielding 4 or 5%. So if you have a balanced portfolio that's, say, 50% in growth investments, 50% in stocks, and then 50% on the fixed income side, the bond side, that side today is yielding a lot more. It's earning a lot more at 4 to 5% than it was a couple of years ago at 2%. So the stock side is really, I'm not speaking to that here when we're talking about the investment factor. Stocks tend to they have historically earned higher rates of return, 8 to 10% on average per year. But yields, have fluctuated quite a bit here in recent years. They went very low a couple of years ago, and now they've spiked up to more normal levels, approaching the long-term averages. And that's what I meant when I referred to the fixed income side of your investment portfolio. Okay, I hope that this was helpful. I hope that you enjoyed this presentation. I've certainly enjoyed it. And I am going to leave this screen up for a couple of moments. It has my email address, has our phone number. Please reach out if you have any follow-up questions, and be happy to talk to you or email you back. Thank you again, and we'll look forward to checking in with you again soon.